Today we're going to go over how landlords should hold their properties. And we're going to use some very basic adages that are extremely powerful, but for landlords could be the difference between success and failure. So they do hold true. And the number one is to own nothing and control everything. You do not want to have real estate in your personal name. And here's why. I could be, let's just say I'm a doctor and I'm making good money, but I realize I don't want to be a surgeon forever, or maybe I'd like to retire and live a little more leisure life, and I want to have assets that pay me to cover and bring in a lot more income so that I can retire because I get used to a certain lifestyle. So I start buying rental properties, and let's say that I go to Indiana and I go to Indianapolis, where I've had a lot of success with real estate, and I find a $100,000 piece of property. So let's just say, here's my $100,000 rental. What's the worst thing that could happen to me on that rental? And you say like, oh, you know, maybe a tenant sues you, a slip and fall, and I lose that property. If I own that in my individual name, the worst thing that could happen to me is I get garnished literally for the rest of my life. And they take everything that I make, or a good chunk of what I make, and then if it's not enough, they come after my estate when I pass away, and they try to take that too. That's the worst thing that could happen. Or I end up in bankruptcy as a result. And before you poo-poo that, and before you say like, oh, you just get some insurance, it doesn't work that way. And I'll give you a real life situation where somebody who was very successful, they were an engineer, and they bought what they thought was their dream home and where they were going to retire. And they said, hey, you know what, I'll rent it out. And I'll rent it out. I'll be real particular, and we'll rent it to a really nice family. And I'm going to move into it in a few years when I'm ready to retire. And those folks that they rented it to destroyed the basement. They ended up flooding the house. They had a shower downstairs that apparently somebody clogged, probably one of their kids, put a towel over it and flooded the entire downstairs, filled it completely with water. And you'd think, okay, so the insurance will cover that. Well, if they had been told, that might have been a possibility, but of course they didn't, and they let the mold infestation occur. And then they sued the landlord for mold infestation that the tenant caused. And before you say, oh my gosh, that's no way, the insurance is going to cover that for sure. No, insurance doesn't cover toxic events or those types of issues. And 9 times out of 10, you're going to find your policy is going to have lots of exclusions, and the exclusions are the big hits. So this individual got the joy of having their house destroyed and getting saddled with about a 4-year lawsuit that ended up going in and having to go through a jury trial. And the good news is it only cost them $250,000 out of pocket. Out of pocket. That's what it cost them, dollars out to cover this thing. They ended up prevailing. And of course, they can't collect against the tenant because the tenant just went into bankruptcy. So the first way is just to have an LLC. The second way is to have an LLC held by a privacy and create a privacy shield. The third way is to create a management company, or I'll call it a family office. And what we're using here is we're using an LLC taxed as a corp. And it could be an S or a C Corp. Generally speaking, we do a C Corp because that C Corp has a 21% flat tax bracket. We're going to try to zero it out. In other words, we're not going to have a whole bunch of money sitting in there. What we're using it for is to have unified management of the assets, and it gives us an accountable plan so that we can get some tax relief and we get some extra tax deductions. One of the things that happens when you own rental real estate is you go into this category of being an investor where you're entitled to certain types of deductions and certain types of things are not deductible. When you can roll yourself into a management organization, then certain types of education, for example, are deductible. You get better treatment for things like an administrative office in your home. You could do something called 280A. It's called the Augusta rule, where you're renting your home. And you don't have to pay tax on the income that comes from the corporation to have its meetings. It's under a tax code, IRC 280A, subsection G2. We've covered it in a lot of the videos. But or if you go to our tax and asset protection workshop that we hold on weekends, you can also find that. I'll put a link, by the way, if you want to go to the tax and asset protection, type in tax and asset protection, or just type in workshop down below and we'll send you the link, or I'll post the link in the show notes. But we go over all of this in great detail in a one-day event. It's from 9 to 3, 9 to 4 usually because we're long-winded. But we go over the different types of LLCs, series LLCs, land trusts, corporations, when to use them, how to wrap it into a legacy plan using a living trust or other types of trusts, how to create a privacy shield around your assets. We go over all of that during that event. So just type in workshop in the comments below and I'll send you that link, or you can find it in the show notes. But anyway, we're using this, and when we're talking about an accountable plan, you got to understand that there's certain types of things. Let me use my cell phone as an example. If I am a investor and I'm just a regular old landlord, I have plan A or plan B or plan 1 or 2, and I just have the LLCs and I do not have an accountable plan, I have to track which of my calls are for business, which are for personal. And I can only reimburse myself the business expense, just the ones. And the fact of the matter is hardly anybody actually does accurate tracking. So when the IRS audits people, the experience and what their stats show us is, like, for sole proprietors, where they're most susceptible to this, they lose 94 to 95% of the time, depending on whether it's a field audit or correspondence audit. In other words, they lose almost 100% of the time because nobody actually tracks the personal use versus the business use. By using that management company right there, guess what? We no longer have to track, because if it's for the benefit of that business, under an accountable plan, it can reimburse 100% of the expense. So there's 280A, there's the cell phone, it works for equipment. You can use an administrative in your office for your home, where instead of doing this $5 a square foot for the home office, we can actually use a room methodology and write off about 20% on, typically about 20% of all the expenses associated with the house. If I'm buying real estate, do not own it in your name. Make sure that you're using at least a limited liability entity. In most states, that's going to be a limited liability company. There are exceptions, so you want to talk to somebody who knows. Feel free to reach out to us. Better yet, go to the tax and asset protection event and learn more. Again, it's absolutely free. Just type in workshop and we'll send you the link. So that's number one, is I can isolate it in a simple entity by isolating that inside liability from that property from me. Number two, I create a great inside liability protection by using in-state LLCs or land trusts or combination, but I also add a Wyoming LLC on there that creates invisibility and also protects you or your real estate from you. It creates outside protection and inside protection. And then that's number two. And then number three is I add a tax component on it by using that management family office, and I create a corporation that gets me even more tax benefits for owning my real estate. Now, generally speaking, people are going to fall into one of those three categories, depending on how complex their situation is, what their tax appetite is. Hey, are you getting these things? Do you already have another business? Is there other places where you're getting tax relief so we don't have to worry about it? Or are you somebody that's just getting smashed in taxes and we have a strong appetite? In which case, it's always, is the juice worth the squeeze? Are we getting enough benefit out of it to cover its cost, and then make sure that it's a multiple, that you're getting a multiple as far as benefit? All of this fairly easy to map out, fairly easy to structure when you talk to somebody who knows what they're doing. Feel free to, again, to reach out to us. If you like this type of content, by the way, guys, please like and subscribe. And more importantly, if there's something you want to hear about or you want us to dive into, put it in the comments below. And if you know anybody who could benefit from this information, please share it.